Welcome back. You've been watching London Eye. I've been in conversation with Julian Mayo, Chief Investment Officer of London-based Fiera Capital. You're not just an emerging market specialist. I believe you're also a small cap specialist. You do own a lot of small cap stocks. In a stock picking sense, how do you look at markets like India?
Well, we do invest in smallish companies. I wouldn't say we're certainly not a small cap specialist. So our capitalization kind of cut-off, if you like, is around $1 billion. So we look at companies that are trading, $2-3 million a day, at least in terms of minimum average daily trading volumes. But nonetheless, it does mean that we're investing below the big cap spectrum, and so that kind of $1 to $10 billion area is often where we find some of our best ideas. But these are bottom-up stock picks where you have to do that extra little bit more work in terms of research. But often these companies would be stock-specific companies, so they're probably they're tied in a sense to the long-term direction of growth in the economies in which we're investing, but they're not macro plays per se. It's not like buying a large bank or a big commodity company or someone like Samsung in Korea. So you're looking at something which is somewhat more more idiosyncratic, if you like.
What worries you about your hypothesis that we are in a 5-6 year cycle, 2 years into such a cycle in emerging markets? What would make you change that hypothesis?
Well, the main thing is the dollar, and I think if the dollar were to strengthen against everything, if you saw the dollar going up strongly against the Korean won or the NT dollar or the renminbi or something like that would be a concern for us, because that would tell us that, so why would that happen? Well, I think if you think of it, if you sort of disaggregate what in theory should matter for currencies, which are basically the real interest rate differentials, so you've got effectively four variables. You've got US rates in nominal terms, you've got US inflation, you've got emerging market nominal rates, and you've got emerging market inflation. So how could that be derailed? One of them, of course, is emerging market inflation rising rapidly, and so therefore, rates either have to go up, which is going to slow growth down, or if they don't, it means that your interest rate differential is reduced or even turns negative. So that would certainly be worrying for us if that were to happen. But we don't see any strong evidence of a big increase in inflation across the emerging world, and it's partly because monetary policy has been relatively orthodox, as I said earlier, within most emerging markets. The other point, on the flip side of that, of course, is and I'm straying a little bit into the US, which again, as I said, is not my main area of expertise, but just as an observation that obviously rates are going up in nominal terms in the US, but inflationary pressure is at the margin is greater in the US, and so therefore real rates in the US are not rising significantly. So therefore, I would argue that I would ask the question, why would that necessarily be dollar supportive in the longer run? So I would say certainly relative inflation would be a problem from our hypothesis perspective.
What's a greater threat? Because people are fretting, investors do fret about inflation in a bigger way. The US interest rate is already at 3%. Mm-hmm. But there are some people, a minority, who believe that maybe it will end differently with growth rolling over, because we're already maybe 8-9 years into a growth cycle in the US. Do you think it's likely that it's not actually inflation, but growth which becomes a scare maybe 6-9 months down the line?
Yeah, I think there is. I think it's at the moment. It seems the evidence is from the both the capital goods markets, but also from the labour market, that the risk is that growth, if you like, surprises on the upside, and therefore that would be more inflationary. That I think is the greater risk, and the risk that rates are hiked by more than the market thinks they're going to hike them. That seems to be. I would say that's probably the main risk. The risk of a rollover in growth sooner rather than later seems to me to be relatively remote.
What about trade wars? I mean, I know the market's breathing a little easier right now than it was 3 or 4 months back, but do you think that could become an issue, or is it mostly in your eyes a China-specific one now?
I think it's to the extent that it is an issue. It is China specific. I mean, I think this is definitely a risk, kind of globally, because you've got these two, the two largest economies in the world at loggerheads, but they are talking to each other, and I think they recognise that, I don't think anybody seriously believes, Donald Trump's dictum that trade wars are good and they're easy to win, or whatever his expression was. That this is, then I don't think anyone's really going to win if there is a significant trade war, least of all the US consumer. So I see, calm heads prevailing in this particular debate, and you end up with some sort of a resolution in the same way. The last time there's a significant global trade war between the two leading economies at the time was Japan in the late 1980s, a time when I was actually living in Japan, and it's these things. I don't think it's going to end quite as badly as some people think.
Is that hope or conviction?
Well, it's a combination of both, really. It's conviction based on, as I said, calm heads and common sense prevailing. But with this administration, you can't really tell.
India, of late, people have started talking about micro versus macro. Would you say that is true of the emerging market spectrum as well?
Well, I think there's two sides to that. The macro determines your cost of equity. How expensive should a stock be? Where should it trade? What are the risks to the valuation? And so I think in the case of India, there's been this feeling that it's a good long-term story. You've got a good long-term growth story in India in which to invest. The disappointment in, for example, in India, has been at the micro level, the performance of stock. Ultimately the stock market is a market of stocks, and the performance of the individual companies, aggregated is what makes the market where it is. And so when you have a market where, in someone like India, you've got potential growth of whatever it is, 7-8%, so whatever the actual number is, plus let's say 3% inflation, you should be getting companies growing at a multiple of nominal, in terms of bottom line, at least higher than nominal GDP in the short term. You should have the better companies should be growing their profits by, let's say, 15% per annum. The actual behaviour of the corporate profit behaviour over the last, even the last couple of years, when profits have been recovering generally across the emerging markets, has not been good enough. And so, we look at India and we like the businesses, we like the macro, but we're sort of frustrated in many cases by what's happening at the micro level. So I think the point you mentioned earlier about a recovery in an improving micro is actually a good thing. What you want to see is, costs under control. You want to see, top line growth. You want to see companies taking market share and so on.